Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, on one investment fund per video, to share how an individual investor like you and I can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Amundi Prime USA Fund, which is a passive indexing fund. Before we get into the fund details, let's first understand what is a passive indexing fund. Traditional mutual funds are actively managed. There is a fund manager with a team of investment specialists who actively manages the fund with the intent to outperform the market or the index the fund uses as a benchmark. As such, the fund manager and his team does a lot of research and analysis work to try figure out how to generate the outperformance, and therefore there is a higher cost involved in the form of management fees. Traditional mutual funds are also traded directly with the fund provider, meaning liquidity is controlled by the fund provider, who can create and remove shares or units according to the transaction flows. These funds have a fixed NAV every day that is used for the subscriptions and redemptions, so everyone who trades on the same day gets exactly the same NAV. Traditional ETFs have the opposite characteristics. The ETFs are passively managed, with the intent to replicate as close as possible the specified index that represents the market. Given there is no requirement to outperform or to evaluate the underlying constituents of the index, ETFs require a much smaller investment team with less work involved, so the costs involved in the form of fees are also lower. ETFs, as the name implies, are listed and traded on stock exchanges just like public equity stocks. Therefore, the liquidity is mainly determined by the supply and demand available on the exchanges. An investor can only buy an ETF if there are shares or units being sold on the exchange. ETF providers can create and remove shares or units, but usually do so for large trades only. Given the trading is done on stock exchanges just like a stock, trading can be done anytime while the exchange is open, and the trading prices will have a premium or discount gap versus the NAV. There are some active fund managers who prefer to run their products on stock exchanges and provide liquidity like stocks. These are termed as active ETFs or actively managed ETFs. The famous, or some say infamous, ARK Invest ETFs fall into this category. There are also some mutual funds that have a portion of their portfolio made available on stock exchanges as an additional trading vehicle for various reasons. These are termed as closed-end listed funds and generally have only a limited number of shares available for trading on the exchange, so they tend to exhibit a higher premium or discount gap versus the NAV. For example, Third Point, which manages multiple hedge fund products, also has a few closed-end listed funds available on the London Stock Exchange. Separately, purely looking at the classifications here, this is also valid for investment-focused companies such as Berkshire Hathaway. Flipping the combinations gives us passive indexing funds that are really similar to traditional ETFs that simply tracks and replicates an index. But in this case, the fund provider creates the product in a mutual fund structure instead of listing it on an exchange. The Amundi Prime USA Fund that we are covering in this video falls under this category. As a passive indexing fund, the Amundi Prime USA Fund tracks and replicates a specific index, that is the Solactive GBS US Large and Mid Cap Index. Given there are more popular US equity indices out there, let's find out more about this lesser-known index and see how it differs from the rest. Solactive is a relatively new indexing company founded in 2007 and is better known for creating customized indices for global investment banks and asset managers that have funds, ETFs, and index-linked structured products that require unconventional indices or indices that have specific rules or requirements. Solactive is a German company, and many of its founders and management team come from Deutsche Bank's structured products business or institutional business, which is where the specialization of Solactive's business direction comes from. Solactive has grown over the years and now has offices in Toronto and Hong Kong to cover the US and Asia regions respectively. The Solactive GBS US Large and Mid Cap Index NTR is quite a mouthful for an index name. Let's break it down to understand it better. GBS stands for Global Benchmark Series. This is Solactive's series of indices that represent country-level equity markets that are more typical to be used as standard benchmarks. US obviously refer to the United States as a country. Given this exposure, the most common indices we can think of for comparisons would be the S&P 500, MSCI USA, and Russell indices. Solactive GBS offers coverage of different market cap exposures. The large and mid cap refers to a basket of stocks that can cover about 85% of the free float market cap in the specific market. For the US market, this currently translates to 452 stocks. NTR refers to net total return, which means the calculation is net of taxes and assumes dividend reinvested. Other variations of the index can be price return and gross total return. The index was launched in 2006. The index fact sheet has better information than the index webpage, where you can find performance chart and past 5 calendar year returns, as well as sector breakdown and top 10 constituents. Solactive rebalances the index on a quarterly basis, similar to most other index providers. Given the index allocates by free float market cap, the resulting portfolio of constituents is not significantly different from the other more established US equity indices in the market. Here are the top 10 positions of the index versus S&P 500, MSCI USA, and Russell 1000 indices. Probably the notable difference among the 4 indices here is that Berkshire Hathaway is missing in the top 10 list of Solactive and MSCI USA, because these 2 indices calculates by free float market cap, and the company has lesser free float shares. S&P 500 and Russell 1000, on the other hand, simply calculates by overall market cap. While Solactive has slightly lesser number of constituents at 452, the fact is that the smaller stocks at the tail end hardly move the needle. We will compare the performances later, though I imagine them to be quite similar as well. Now that we understand the index better, let's take a look at the fund itself. Amundi is a French asset management company founded in 2010 from the merger of the asset management businesses of Crédit Agricole and SocGen, 2 of the leading financial institutions in France. Crédit Agricole has 80% ownership of Amundi, while SocGen has 20%. Amundi IPO'd in 2015 in the Paris Euronext and has been growing strongly through organic business growth as well as multiple acquisitions. Today, Amundi manages over 2.2 trillion euro worth of assets, making it the largest asset manager in Europe. Amundi's businesses are well diversified. Client base covers the full spectrum from retail and private banking through third-party distributors, to insurers, to sovereigns and institutional. Europe, with France in particular, obviously covers the bulk of the business, though Amundi has been relatively successful in Asia with about 21% of AUM from the region. Product diversification-wise, about half are active managed products, while 19% are passive solutions, which is where this fund falls under. The Amundi Prime USA Fund is a sub-fund under the Amundi Index Solutions fund family. Amundi Index Solutions is set up as a Luxembourg SICAV structure and is UCITS qualified. It essentially covers a long list of passive indexing funds that are too many for me to count. As a result, the prospectus has over 1,000 pages. I'm not kidding. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The strategy of the fund is straightforward. As a passive indexing fund, the objective is similar to a traditional ETF, which is to track and replicate the intended index. The fund uses a full physical replication approach, meaning it will invest in all the stock constituents of the index and will allocate as close as possible the same found in the index. There will obviously be small tracking errors due to actual implementation processes, which is similar to normal ETFs. Given this is in a mutual fund structure, NAV is calculated once daily on a forward pricing basis, so all trades for the day get exactly the same NAV. Settlement is 2 days after the dealing day. The fund appears to be available in only 2 share classes, AUC and ASC. A refers to retail share class, U is for US dollars, and S is for Sing dollars unhedged. C refers to capitalization, which means accumulation class. The records show that the fund was incepted in 2019, but these 2 share classes were only launched in March 2022. So perhaps there is an undisclosed share class that was launched earlier. As a passive indexing fund, fees tend to be low, and Amundi does it well with this fund, setting the TER at just 0.05%. Given the nature of the fund and that the TER is already so low, there is no trailer fees that can be shared out, and therefore some distributors may not carry this fund. Amundi allows distributors to charge up to 4.5% subscription fees, although as an investor, you should ask for the same rate as with normal ETF transactions. Fund size is at about 0.5 billion US dollars currently, which is considered small if compared to the usual US equity ETFs in the market, but it is at least large enough to avoid fund termination concerns. The main concerns investors may have with the Amundi Prime USA Fund are whether the Solactive index is as comparable and relevant as the more established indices such as S&P 500, MSCI USA, and Russell 1000, and also whether there are any notable impacts due to the product having a mutual fund structure instead of an ETF structure. Both of these concerns can be addressed via the performance of the fund. If the performance is comparable or even better, that will reflect that both the index and the structure are good enough for the purpose. Looking at the performance of the fund alone doesn't tell much, so let's run some comparisons. Looking at since inception in March 2022 till date, that gives us about 3 years worth of track record. The Amundi Prime USA Fund delivered 48.16%, which is just about 1% lower than the usual S&P 500 ETFs such as SPY, VOO, and SPXS. On the other hand, the fund performed better than the MSCI USA Index, as well as the iShares Russell 1000 ETF or IWB. Looking closer at 1 year period, the Amundi Prime USA Fund delivered 17.40%, which is almost the same as the S&P 500 ETFs, but has underperformed the MSCI USA Index and the iShares Russell 1000 ETF. These 2 charts suggest that the Amundi Prime USA performance is more similar to the S&P 500 ETFs, which also infers that the Solactive GBS US Large and Mid Cap Index provides a similar investment exposure as the S&P 500 Index. Deviations from the MSCI USA and Russell 1000 indices are slightly more visible, though on a long-term basis looks to be still similar enough. At the same time, these are also infer that going with a mutual fund structure gives a similar result as an ETF structure. Let's do a quick conclusion for US dollar investors. The Amundi Prime USA Fund, as a passive indexing fund, provides an additional choice to investors looking for passive US equity exposure. The positive aspects are that performance is comparable to S&P 500 ETFs and fees are low. The negative aspect is that the fund AUM is lower than the main ETF players, so investors that are more particular with fund size will give this a pass. The other differentiator is that this product provides investors a mutual fund structure instead of an ETF structure. The positive aspects are that a fund structure is useful for investors that do not want or cannot invest in ETFs for specific reasons, and as well for investors who like the mutual fund concept of trading with a fixed daily NAV instead of having to consider premium or discount effects on exchange trading. On the flip side, the negative aspect is that this is not suitable for investors who prefer the ability to trade intraday like ETFs. Investors who usually use the ETFs as underlying for structured products are also unlikely to be able to use this fund as well for the same purpose. So, in conclusion, the Amundi Prime USA Fund serves a specific group of investors who are looking for passive indexing funds instead of ETFs. Beyond that, it is unlikely that the fund will gather as much interest and AUM as the established ETF players in this market. If I am a US dollars investor, I will probably still go for the usual SPDR or Vanguard ETFs. The next few minutes are specifically for Sing dollar investors, who have a slightly different investment environment that makes this fund potentially a lot more appealing. Let's talk about two important realities. The first is that there are hardly any ETFs that trades in Sing dollars. As far as I'm aware, there are no US equity ETFs that trades in Sing dollars. Even if there are any ETF providers willing to create such a product, the Sing dollar investor market is simply too small to generate enough trading volume to make the product sustainable. The second is that there are no core US equity mutual funds out there that can consistently outperform the S&P 500 index. I'm not talking about the thematic focus or sector focus funds, but those with strategies that are more into broad-based core US equity market. The US large cap equity markets is a highly efficient market, making it difficult for an active manager to generate outperformance. There would be the occasional thematic bets or single stock bets that helps an active manager on the returns, but these often fizzle off after a while. So while many mutual funds offer Sing dollar share classes, the resulting performance will still be lacking. Therefore, passive indexing funds that provide Sing dollar share class offers a potential solution for Sing dollar investors here. The Amundi Prime USA Fund is one of the few passive indexing funds with a Sing dollar share class. Other notable ones in the market are the Infinity US 500 Stock Index Fund from Lion Global and the iShares US Index Fund. Both Infinity and iShares track the S&P 500 index. All the Sing dollar vehicles are currency unhedged, which is quite common for equity funds. In this 3-year chart, I have included both the Sing dollar and US dollar version of the Amundi Prime USA Fund, as well as the Sing dollar versions of the Infinity and iShares funds. The iShares fund was launched slightly later, so let's ignore it in this chart. Comparing Amundi and Infinity, Amundi has delivered about 3% more, which makes it a better pick on performance basis. This is partly due to the much higher TER of 0.6% for Infinity. Infinity does provide trailer fees to distributors though. So if you are with a distributor that provides trailer rebates, that will help reduce the performance gap with Amundi. Separately, comparing the US dollar and Sing dollar versions of Amundi, we can see here the performance deviations due to FX fluctuations. Interestingly, the resulting performance in this 3-year period has been quite similar because the Sing dollar to US dollar exchange rates are quite similar to the levels 3 years ago. If we shift the starting date about 6 months to the inception of the iShares fund, we can see that the Amundi's performance remains slightly better than both Infinity and iShares, even though iShares TER is also quite low at 0.08%. Performance between the US dollar and Sing dollar versions of Amundi, however, is significant here, with the Sing dollar version lagging behind by about 10%. This is because the starting date happens to be at a low point in the exchange rates. This shows that exchange rate market timing plays an important part when investing in products with unhedged trading currencies. Finally, on 1-year basis, all 3 funds again are quite similar in performance, with Amundi leading the pack slightly. So let's do a quick conclusion for Sing dollar investors as well. The Amundi Prime USA Fund, with its Sing Dollar share class, fills a product gap whereby the availability of Sing Dollar vehicles for passive exposure to core US equity is lacking. We are not even considering active funds here, as there are hardly any mutual funds that can outperform the S&P 500 index consistently. While there are not many choices available in this space, the Amundi Prime USA Fund at least has delivered a slight but consistently better performance than its competitors, making it a preferable pick over the others. One key aspect for investors to note is that the performance deviation to the original US dollar vehicle due to FX fluctuation can be substantial, as seen in the earlier charts. For investors that do not mind holding some US dollars, I would strongly suggest to convert some Sing dollars to US dollars at an exchange rate you feel comfortable, then use the US dollars for investing into the US markets for long term. There is a much wider range of investments available in US dollars than in Sing dollars, so having some US dollars for investing is beneficial in the long run. This concludes my absolutely biased comments on the Amundi Prime USA Fund. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.